If you're on a low income and you want to buy, you're talking about quite a big relocation.
There's a significant amount of Australians who do not earn the median wage.
It's crazy how communities are being split and only 20% can afford first homes.
Housing affordability, or lack thereof, has become one of the biggest topics in Australia in recent years. So how did we get here? Joining me to unpack the data and analyse the state of play is senior economist at PropTrack, Paul Ryan, the author of the 2025 PropTrack Affordability Report, the most comprehensive measure of housing affordability in Australia, and Dean O'Brien from O'Brien Real Estate, who is seeing the affordability crisis play out on the ground. Thank you so much for joining me, guys. Paul, this report, I have to admit, it's terrifying. Even just from 12 months ago, affordability has deteriorated further. What are the big headlines from this year's report?
We've constructed this report to look at housing affordability for all Australians. So we've tracked the share of homes that households on different income levels can afford. And it is the lowest level that people could afford in at least 30 years. To some extent, that's people's experience on the ground. But also, I think it shows that the way we've calculated this is based purely on people's income. If people were turning up and trying to buy a house at the dated price that they're selling for, and it shows that people who are buying houses now are increasingly relying on wealth and family wealth increasingly to enter the market.
So this data is based on what we call an affordability index. Can you explain firstly how it's worked out? And then what do we actually mean when we say affordable?
We've looked at households of all income levels across Australia. And then we've said, if that household had gone throughout their state, how many homes on that income level could they afford to make mortgage repayments on? And so a standard mortgage, 80% of the home's value, using 25% of their gross household income. We've made some assumptions there, but broadly speaking, that's at a high end of the level of affordability for a given household. And then we've looked at all the homes that sold over the year. How many of those homes could they buy?
I think the key thing there for me was that what we classify as affordable is 25% or less of your household income going towards your mortgage. Dean, over the 23 years that you've been in the industry, does it surprise you that right now housing affordability is at its worst level?
Does it surprise me? No. Just based on the conversations we see every weekend at the open for inspections and during the week when we go to houses to see how people are travelling, the conversations we're having with our potential vendors, it is the topic of conversation at all time. You know, we talk about buyers to get into the market, what you can afford. We're getting a lot of conversations at the moment. How can we afford to hold? So it doesn't surprise me that we are, and it's so heavily discussed every day in our office and with our clients. So I'm not surprised that when I heard that number, that it was actually scary to hear that number, but it doesn't surprise me that is the number.
Paul, what are the main factors contributing to this deteriorating affordability?
So over the past year, we saw interest rates increase very slightly, but the big one was home prices kept growing. At a national level, we saw home prices increase 6.6% over the year. So those two factors combined to make homes a little bit less affordable than they were a year ago. But the big story has been that there's been a rapid deterioration in affordability since interest rates started to increase in early 2022. You can understand why young people trying to crack into the market are so disillusioned, I think.
Dean, are you seeing this with the first home buyers you're dealing with? Are they kind of compromising, I guess, on their property type? Are they lowering their budgets? Are they actually just taking longer to get into the market?
We get a lot of buyers. We've done some focus groups with first home buyers in our marketplace, and they are very concerned about getting into the market. When Paul said disillusioned, they are very disillusioned because, you know, their parents often taught them about how to save. You know, they were the generation when they go, we've got to save, you've got to get your house. Now, that's still a conversation I'm sure that they're having with their parents. The goalpost just getting further and further away. Typically last year and the year before, it was about prices increasing. Now it's about affording to actually get into the market. So they've had a good 2 to 3, 4, even 5 years of disappointment.
But I want to look at that typical household income because, you know, this is the cohort of people earning just a tick over $110,000 per year as a combined household. That's not a low amount of money. That's a very decent salary in this country. So that typical household, that 50th percentile, Paul, what can they afford to make repayments on? Because I feel like this is the cohort that deserves to be angry about affordability.
So if you were on a typical income, about $112,000 a year, you could afford 14% of homes across the country. And in New South Wales, that was as low as 1 in 10 homes.
How does this compare, though, I guess, to even just a few years ago in kind of that 2020 to 2021 mark? Because there was quite a housing boom for that first home buyer group back then.
So during the pandemic, 2021, we saw more first home buyers than we'd seen since 2009. And 2009 was a period when there was very generous government support for first home buyers. And the big reason for that was that interest rates were lower. And that meant that people could get into the market just with their incomes, not relying on wealth, which is how most owner-occupier upgraders are transacting. So yeah, we saw a huge boom in first home buyer ownership. These were the best affordability conditions we'd seen in about 20, 25 years. And there was this big shift. We saw a shift away from investors and towards first home buyers. And there's this common adage that first home buyers and investors compete for the same properties. And during the pandemic, we saw first home buyers very strongly, winning that battle. And at the moment, it's flipped very quickly back to investors and away from first home buyers.
In 2020 and 2021, that median household income, they could actually afford 43% of homes sold in the year prior. So that means that in 3 years, a median household income has gone from buying you 43% of homes to now 14%. That decline within a 3-year period is absolutely wild, and I actually feel like in a few more years, I wonder how many percentage of homes they will be able to buy, 1 or 2, who knows? But Dean, how is this affecting the upsizer market in your area? The upsizer market is those families who are looking to transition from maybe that apartment to the standalone house, the 3-bed, the whatever. Are they finding anything? Or I actually kind of think, are they even bothering to look?
It's a bit of both. I think they're always trying to look. And then we're finding that upside market, unless they have to, due to circumstances, and there's various circumstances at the moment. One of them is the fact that obviously an extra family member, so they have to move based on accommodation. But in our market as well, there's another sort of thing that's happening is that even though that these guys that bought at the low interest rates, when they go to look to upsize now, they can only maintain the same loan. So they can't actually move because the affordability of that new loan to upsize, even though they've got some wealth behind them and they've got an income, the income hasn't gone with the cost of living. So it's a very difficult place for those upsizers. I know that a lot of them that we talk to that are out looking, hoping, aspirational, are sometimes just trying to hold the home. They're probably doing some more improvements on the home at the moment, and doing that. So unless they have to actively upsize, they're not doing it.
Yeah, it's almost like that first home you buy with the plan of it maybe being 3 or 4 years. All of a sudden that's come out to 7, 8, 9 years because they're just hamstrung by, as you say, like they've got that wealth behind them, but they're still only able to service that same loan amount.
One of the markets that I trade in, which is out in the southeast of Melbourne, it was a great market. It's a great place to do real estate because we had first home buyers, second home buyers, aspirational buyers. So therefore, we always felt that we had a great market that we could transact in, high level of turnover, very good for real estate and certainly an investment marketplace. We're now finding that because those ones that would transition just aren't, and as you said, it was a 3 to 4 to 5 year turnover. It is now stepping out. I'd love to know, Paul, the stats on that because it's now stepping out to well and truly because we've got a lot of guys, especially even guys in my team, that have looked at it, had the extra family member, have gone out and said, look, we need that bigger house. But when they've gone to their broker or to the bank or whoever they choose to use, they're just saying, if we do that, we can't even get you a greater loan. So they're actually restricted to the house they've got. So they've got to either create more wealth, create more income. But again, that's now with the cost of living and that extra family member, it's a lot tougher for these guys. So we're having these conversations a lot, and I'm having them with my team.
I want to step away now from that median income and let's look at the low income households because there's a significant amount of Australians who do not earn the median wage. Paul, can you give us a state of play where they're at?
One of the most concerning things that came from this report is how low-income Australians are effectively locked out of home ownership. people who are on low incomes at the 20th percentile, which is a bit more than $50,000 a year, and that's the lived experience of 1 in 5.
Is that 20th percentile means the lowest 20% of earners?
Yeah, that's exactly right. So someone who's earning just above what 1 in 5 Australian households earn, earning a bit more than $50,000, could afford to buy just 3% of homes that sold over the past year. And the location of those homes is likely to be remote regional areas.
Is that 50,000 pre-tax, post-tax?
Pre-tax. But for low incomes, they're quite similar. If they're in capital cities, they'll be apartments, and more likely than not, they're extremely regional, not well-located homes. So effectively, if you're on a low income and you want to buy, you're talking about quite a big relocation, or realistically, I think it's renting for a considerable amount of time.
But what's the price bracket that they can afford? Like, okay, so their income is 50 grand, but what can they comfortably afford when it comes to the value of a property?
The 10th percentile for prices is $300,000 nationally. So the 3rd percentile will be $120,000, something like that.
Dean, is there any stock in your patch actually worth $300,000?
No, I bought my first house and it cost me $135,000, but that was in 2001. 3-bedroom, 2-bathroom, single lock-up garage on a 300-metre square block in Berwick. And that cost me that in 2001. So to be 23 years on, it's just unheard of.
Pretty much that lowest percentile can say goodbye to Southeast Melbourne.
Well, not only Southeast Melbourne. I grew up in regional Victoria, northeast, in a great town called Alexandra, and there wouldn't be anything that far, and that's 2 hours from the CBD of Melbourne as well. So that whole area, that Marysville, Buxton, northeast, where I grew up, where that was typical prices. When I was growing up, you could buy something for $80,000. But now you won't see anything on the market under $450,000 in regional Victoria. It's 2 hours from CBD in northeast Victoria.
Let's flip it and have a look at the other end of the spectrum, but it's the high income households. So it is the top 20% of earners in Australia earn a household income of around $213,000. So, Paul, what does affordability look like for them at the moment? Like, what percentage of homes could they buy in the last year?
Affordability has declined for everyone because borrowing capacities have declined quite rapidly. People can borrow on the same level of income roughly a third less than they could a few years ago. So if you were a high income earner earning more than $200,000 a year, a few years ago you could afford more than 3/4 of all homes sold across the country. Now it's just above 50%. So that's the level of income you need to be able to afford on mortgage repayments alone a typical home across the country.
Even the top 20% of earners in this country could only comfortably afford 50% of all homes sold in the past year, which is crazy. So from this report, Paul, what is their max price that they're comfortable with before they start to feel mortgage stress?
That's about close to $700,000. And if you look across capital cities in particular, $700,000 doesn't get you as much as it used to.
The top 20% of earners can only comfortably afford a home worth $700,000.
With income and mortgage repayments alone, that's right. And the reality, I think, is that a lot of those high income earners also have high wealth, and that's how they're able to transact higher price points than that $700,000.
I'm genuinely shocked. I was going to say something like my guess would have been maybe $2.5 million before they started to feel mortgage stress. $700,000.
Well, that doesn't surprise me, but that house I bought for $135,000 sold for $760,000, and it's amazing now that only the top 20% of wage earners can actually earn. That's a first home house.
That's right. $700,000 is not.
That's amazing.
If a first home buyer told me that's what they spent on a house, I'd go, whoa, bargain.
I'm pretty sure PropTrack put out an article in the Herald Sun not long ago that the cost of household incomes in certain areas at the moment is extraordinary. And you look at it and say Bayside area, certain parts of Bayside area, to have that 25% on top of that, it was $488,000 just as a household income to come in to live in Bayside. So it's crazy how communities are being split and only 20% can afford first homes. That was 20 years ago, the first home to now.
If the top 20% can only comfortably afford a home worth $700,000 without, on obviously income alone, Melbourne has a median house price, and I'm focusing on Melbourne because that's where I am. Melbourne has a median house price of almost $1 million. Do you think, Dean, that, you almost need to be a high income and generational wealth type of family to purchase a property?
Yeah, or you're going to need parental contribution or parental guarantees, which we're seeing a lot of at the moment.
Do you see this?
Absolutely.
Yep.
It's we're finding a lot of people at the moment. We're getting out in the southeast of Melbourne that a lot of families are selling their inner house and giving their next of kin an opportunity, deposits to get into the market, and then coming out and buying out our way to support them on the cost of living, so they don't have childcare, etc., like that. I think there wouldn't be a weekend where we wouldn't see a buyer that's actually even an auction, and we had an auction last week out in Cranbourne, and it went for 1.65 million.
Wow.
I know. 4 bedrooms, great best home. It was the best home in the area auction on that weekend, but that was still going back to the parents to see if they could afford to go more. They weren't doing it on their own. So unless I think there's parental guarantees or parental contributions, it's just going to be harder and harder for our buyers in our marketplace because, it's to think that they can afford $700,000. Our average sale price is $900,000, and it's even progressing out to Warragul, Druin as you go. And as I said, even going to the northeast of Victoria, 2 hours from Melbourne, we're seeing houses that sit at an average sale price of $500-600. It's just crazy the way the world is going, and especially for us, where again talking about Victoria because that's where I know more about Victoria. So it represents that in the marketplace.
We've covered off the buyer groups, but now I want to change gear a little bit to have a look at where in the country is experiencing the worst affordability. Paul, what does the nation look like at the moment?
There are some trends across the nation. We've seen affordability decline everywhere, but we're still seeing the toughest housing affordability conditions in New South Wales and Victoria and Tasmania. Tasmania is seen, actually, if you go back to 2015 or so, is one of the strongest markets, and that's had a big impact on housing affordability there.
Is Tasmania deteriorating because that's based on the income of the people who live there?
Yes. So Tasmanian incomes tend to be a little lower, but they've seen rapid home price growth over the past couple of decades. And I think that's one of the reasons we're seeing much slower growth across Tasmania at the moment, is that affordability is just really biting that market. And the other big call out is that Western Australia is far and away the most affordable state across the country. A typical Western Australian household could afford 26% of homes that sold over the past year, and that's substantially higher than any other market. So it's no surprise.
Nearly double what we were talking about before.
I think that's a key reason why we're seeing the Western Australian market really charge ahead over the past year. Perth's seen price growth in excess of 20%. I think affordability is a key driver. We can see how that's impacting markets across the country.
Dean, are you seeing people move out of Metro Melbourne to be able to afford a home?
It's just more and more common moving out of Metro Melbourne and into the outer suburbs just to afford a home. To have that home ownership is still on their goals, but they have to move further and further out each time. And that you can see that on the Monash every morning, can't you, with the cars that are coming in, and especially now when a lot of people are coming back to work in offices, and to hold the incomes that they require to hold these houses. The outer areas don't actually offer those jobs. So the stress on the infrastructure and roads is happening more because the home ownership is getting further out every week.
So, Paul, the report also mentioned that saving for a deposit is at a record high. Can you give us a really brief overview of what that looks like?
Deposit saving, I think, for first-time buyers is the other big challenge. Firstly, the report shows you've got to have a really high income to make mortgage repayments. But
it's almost the biggest hurdle.
Absolutely. You hear of lots of first-time buyers not meeting that 20% deposit hurdle and paying LMI. But to reach that 20% deposit level across the country, you're looking at saving for about 5.5 years. And that has a big impact. It means people are renting for longer. Rents are increasing. People are trying to save this deposit while paying higher rents. It's a big strain for first-home buyers, and I think it's another reason why they're really disillusioned at the moment.
Oh, totally. But in the 1990s, the average time it took to save a deposit was about 3 years. So now that's essentially doubled, which actually means that if someone wants to buy a house when they're, say, 35, which actually is below the average first-home buyer in this country, I think, Paul, correct me if I'm wrong, but I think it sits at 36, 37 for the average first-home buyer. So that means that if someone wants to buy a house when they're 35, they have to kind of seriously start saving when they're 29, 30. But that actually doesn't include the increase in house prices.
Yeah, absolutely. I think particularly during the pandemic, a really common anecdote was that people weren't able to save as fast as home prices were increasing. You can understand how demoralizing that is. And so you had, lots of FOMO buying, people trying to get in with whatever they could because they felt like the market was getting away from them.
Dean, with all these barriers and hurdles that not just first home buyers, but everybody is experiencing when it comes to the property market, are you seeing any interesting approaches from buyers to get into the market?
Yeah, we are. Look, as I say a bit earlier there, that they are certainly going out and being a little bit more educated. They're probably building better relationships with their broker. And I think that's for the best of the advice we can give them. Make sure you're very close to it. One of the things too is the conservatism on an auction day. They aren't getting that FOMO buyer anymore. We had so much of that in the pandemic. It was buying property sight unseen. It's unheard of to put such an investment sight unseen. So now we don't see those FOMO buyers. We call them bank buyers, that the bank just says when they have to stop and they're educated in that space. But one of the good things I will say is that they're getting closer with their brokers and getting closer with their agents. And of course, there's not an abundance of buyers all the time. So the agents are actually doing some great work with these future buyers. So at least that's happening now, instead of typically a real estate agent would put a property on the market, just wait to auction day, if it was even going to make auction day, with ridiculous offers. Now, I think there's more communication, there's more connection between brokers, agents, and the buyers, which is great.
Paul, I'd really love your prediction, which I know this might be hard, but what is your prediction for the housing market going forward? Do you actually think we might be able to get back on track so more people can afford it?
I think in the short term, we're hoping that affordability improves when interest rates decrease. That's been the big driver of the decline in affordability over the past few years. But if we look back further, the really low level of housing supply is the thing that has driven affordability down over the longer period. So while I'm encouraged by kind of the National Cabinet goals to build 1.2 million homes over the next 5 years, those are the goals that we really need to achieve if we're going to have a meaningful impact on improving housing affordability over the next 5-10 years. And if we get back to kind of the next generation having the experience of the previous generation, which was a typical household being able to buy a typical home. So I think there's quite substantial structural changes that are needed to get back to that point. And hopefully we're sowing the seeds for them now.
So Dean, do you have any words of encouragement, I guess, for people who are listening who are in the market looking to buy at the moment?
I reckon it's a great time to buy after all these conversations that we're having because of housing affordability. But if you're in Melbourne at the moment, we're still seeing, we haven't had the growth that New South Wales, Adelaide, Queensland, Perth have had. So we've got probably prices that were seen 18 months ago. So I think it's really important to understand that. On top of what Paul just said, then touch wood, we're at the top of the rate cycle. So there's that optimism as well. But look, my number one advice has been, and it's never actually changed since I've been in real estate, and I've got it, look, just find a house that you can afford and don't be afraid to go outside of your core area it's required, because that first house won't be your last. And if things change in life, and you do come into some wealth or you've got greater jobs, you can always move around, but you've got to be in the market to move around, because 5 years, 10 years from now, it's taking 5 years to save for a home loan now. 5 to 10 years, prices are going to go up. So you'd rather be in the market than out of the market, and then you can actually ride the market all the way through. So just don't be afraid to move.
Thank you so much to both of you for coming on. I read this report start to finish before we did this episode, but even then, I've actually been shocked just by us discussing it and what it all means and unpacking the numbers and the data and where in the country is affordable and not affordable and all the rest. So I really appreciate both your time. Thank you.
Thanks, Alice.
Thanks very much.
Thanks for joining me. This has been Real Talk. For your weekly fix, please follow wherever you listen to your podcasts, and tune in next time for more real questions, news and insights on the topics that matter most from realestate.com.au, Australia's #1 address in property. All information provided is general advice and opinion based on current market conditions. These opinions should not be treated as investment advice. Always obtain advice based on your individual circumstances.
Real Talk acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, air and community. We pay our respects to elders past and present.